Financial markets are made up of people, not robots. The idea of perfect or rational financial markets forms a central component of investment theory. Rational markets are basically ideal markets. It is a world in which buyers balance sellers. The central idea is that markets will always generate the right prices whenever new information about assets becomes available. So how does this all happen? According to investment theory, people are rational. They will react logically when presented with new information, and no emotions are attached. This implies that buyers and sellers are well-reasoned individuals that assimilate all available information to conclude deals at economically correct prices. In other words, financial markets are ideal places. For this to work, it is assumed that people have the same goals, and when presented with certain information, they will all make the same decision. It is also assumed that these decisions are made independently of each other, meaning that prices reflect a market consensus rather than the opinions of a select few. In reality, financial markets work a whole lot differently. Once again, the assumptions underlying rational markets don't make any sense, as highlighted by the following reasons. Reason number 1. The fields of behavioral economics shows how people misinterpret information and how emotions can cloud financial decision-making. When it comes to money, emotions fly high and people make mistakes. Reason number 2. Financial markets are dynamic and people are not alike. People view the world differently, and there are a myriad of psychological factors that drive human behavior, not to mention decision-making. Reason number 3. Rational markets require that investors act independently. On the contrary, financial markets may only reflect the opinion of a few people. In essence, a small number of people participate in markets, while the rest follow. Reason number 4. Share prices should always reflect the underlying company's true value in rational markets. And reason number 5. There is another question that the theory is unable to answer. If financial markets were rational, why is it that the stock market generates higher returns than cash investments? In other words, why do people expect better returns in the stock market than cash sitting in the bank? Rational markets propose a number of weird assumptions, which culminated into modern-day investment theory. What is clear is that financial markets are not driven by robots, but by people. And where you find people, you find emotions and complex behavior which cannot be quantified by fancy equations. Are you ready for financial wealth? If so, visit our website at waytowealthpro.com for your free copy of the 6 Golden Rules of Building Wealth right now.